Thanks for joining me today on the tax planning training. So today we're running through how and why we do tax planning for businesses. So we do tax planning at Northwest Accountancy for a few of our businesses every single year. And it's a really great way to know what the business is up to review where the previous 9 months is. So we normally do tax planning up until the end of March each year, sometimes April, depending on the timing. Know what the business is going through, what's going to come up in the next 3 months to the end of financial year, and then from there work out if there's any strategies that the company or the business needs to do in order to make a profit, to have the amount of tax set aside that they need to reduce losses. So if you're making a loss in the business at the moment, what can we do to reduce those losses so that you've got more cash available in the business, and to see what strategies need to be implemented. We also use our tax planning meetings as a chance to catch up with our clients and see if there's anything bigger that we need to help them with as well. So things like looking to purchase property or purchase plant equipment, or looking to retire and finding the way out of running the business. So there's quite a few topics that we do run through with regards to tax planning, and it can be quite customized to your business. So I'm going to start off with first around what is tax planning. So tax planning is the name that we use to check that you have enough tax, to check what your tax might be for the year when we go to lodge your tax return in 4, 5, 6, 12 months time, depending on your business and when we do your financials. We work out what's important for your business, and like I said, we come up with some strategies on what needs to happen. Now, as an accountant, we can do all these calculations, but we really like to work with you, the business owner, to make sure that what happens for your business is what you want to happen. So we can recommend a strategy, but if you're not going to implement it because it doesn't feel right to you, then that's absolutely fine as well. So our recommendations are that they're just recommendations, and we're not going to force you into doing anything that you don't want to do. Now, why is tax planning important? It's a really good snapshot of where your business is at. If you need to do work with your bookkeeping, then we need to see that now before the end of financial year so it doesn't turn into a disaster in a few more months' time. What happens when we review your books at this stage is we make sure that your balance sheet and your profit and loss look okay. So there's no big, hairy, scary things that we are blindsided by that we can't unfix after the 30th of June, and I'll tell you about a couple of those in a moment. And to make sure that you're on the right track with regards to running your business. So you've got your cash flow management systems down pat, you're making money and you're keeping money in your business. We're making sure that your liabilities as an owner are being met. So making sure that you're paying and lodging the tax bills on time, making sure you're paying and lodging your superannuation on time. Those things are really important because as a director of a company, you're personally liable for those. As a partner in a partnership or a sole trader, you're personally liable for making sure that those taxes and superannuations are paid. And the government has been known to come back and take those individuals, take their personal refunds to pay for bills or debts of the business. So we like to keep on track and make sure that your business is on track of those things and you're paying those things that you need to actually pay. One of the big things that's happened in the last 3 years is single touch payroll. So single touch payroll is the act of reporting to the tax office your payroll liabilities, so your payroll, how much you're actually paying people, but your payroll liabilities in respect of the amount of tax that you're withholding from wages, and superannuation as well. So single touch payroll is an on-time reporting system. So when you make a pay to an employee, you need to report that data to the tax office straight away. So it's within the same day of making the payment, you need to report to the tax office. So when we come to tax planning, it's really important if we're doing anything in regards to tax planning for owners in relation to wages, whether that be to the owners themselves, to their kids, to any part of their family members. When we're paying wages, we actually need to pay it within the same financial year and report those payments to the tax office. If we're not making a payment for wages until August or September when we're doing your tax return, because that's when we've noticed that you've made a profit and it's more tax effective to put that wage out to an individual rather than keep it in the business and paying tax on it in the business, it's too late. Yes, you can make adjustments to the single touch payroll system, but it's lots easier to do the payroll when it needs to be done in the correct financial year than go back a couple of months later and readjust it. So we want you to do end of year financial rollover for your payroll once and get it right the first time. So we don't, through tax planning, do a whole load of payroll review. That is a separate a bit of advice that we do, a payroll review, a separate service that we offer. But it is important that if there's any adjustments that need to be done to wages, that we do them now in the next 3 months rather than waiting until when we do your tax return. So that's one of the key, most important reasons why we do tax planning at such a March, April time, because we've got adjustments that we can make real time and report them to the tax office when we need to. Another reason why tax planning is really important is so that we can get the most out of your tax claims. So as a business, there's things that you buy within the business that you want to claim as a tax deduction, and that's absolutely fine. That's what we want you to do. It's making sure that you have the money to purchase those things and make sure that we get the correct tax reasons for that. One of the biggest things that has happened in the last year is that your claims for purchasing equipment and vehicles and those big things in your business, the claim amount for that has gone up to $150,000. So in previous years it was $30,000, $25,000, and way back it was $1,000. So our tax planning has become quite interesting now because you can go and finance a huge piece of equipment, get a loan for that, start paying the loan down, but the actual purchase of that equipment, once that is installed and ready for use in your business, it's claimable as a full tax deduction in the year that you buy it. So you might buy, I don't know, a digger or a piece of equipment that you use within your business, and you might finance it for 5 years, but you get to claim it not over that 5 years, how long you've going to finance it for. You're going to claim it in the first year. So when it comes to tax planning, we can go, okay, well, there's no tax to pay for this financial year, but there will be tax to pay in subsequent years because you aren't doing what we used to do, and which is called depreciation, and depreciating that item over the life of the item, you're claiming it all now. So yes, you're getting a huge tax deduction now and there's no tax to pay now. That's great. But next year and the year after and the year after, there will be tax to pay because you haven't stretched that cost over the life of what the item is, which is what depreciation is. So in doing that, by bringing that claim into this financial year, we're manipulating the timing of that claim and making sure that you've got enough money set aside for future tax is also important for us as well. Another reason why tax planning is really important is because it makes our end of financial year run smoothly. So if we're looking at your books once a year and we're coming in and going, okay, so this is your tax position, here's your tax return, sign the forms, here's how much your tax bill is. There's not a lot you can do about it. But if we do tax planning now, before the end of financial year, then we can give you those ideas and those things that you can adjust and change so that you then know what your tax bill is, or could be, or should be. Probably could be is the best word for this because it's an estimate. It's only an estimate. So we know what your tax bill could be if you're looking at a tax bill. And if you want to and you have the cash to be able to do that, you can make adjustments to that. So by spending money on something, and I'm going to give you a company example here. So as a company, if you have a profit of $10,000, then $2,600 is tax. So a company pays tax at 26% for the 2021 financial year. So as a $10,000 profit, you pay $2,600 in tax. If you have that $2,600 and you squirreled away into your tax bank account, then that's good. You might be happy with that. The rest of the money, so the rest of the 10,000 minus the 2,600 is your profit. So profit after tax. And the higher that figure is, the better. If you wanted to make a claim and purchase something for $5,000, then this would reduce your profit by $5,000. So your profit then goes from $10,000 down to $5,000, and instead of paying tax of $2,600, you're then going to pay tax on a profit of $5,000. So 10 minus 5 is $5,000, and tax at 26% is $1,300 worth of tax. So you're going to spend $5,000 and save $1,300 in tax if you're a company, if you're operating as a company. Those figures are different if you operate as a trust or a partnership or an individual as a sole trader, because you're based on individual tax rates, where the more you earn, the more tax you pay. So we'll do specific calculations for those businesses, but for companies, really quite easy to understand and to work out. If you spend $5,000 on a tax deduction, you'll get a saving of not having to pay $1,300 in tax. How's that working for you? So in order to not pay any tax at all in your business, you have to make no profit. And what's the point of being in business if you're not making profit? Not much, really. The last reason why we look at tax planning as an important function of your business is that we can ask any questions and make sure any errors are resolved in your bookkeeping sooner rather than later. So one of the areas that we can look at in your tax planning is GST, and making sure your GST is up to date, making sure that you're not getting any fines or penalties for lodging late, and also checking your bookkeeping and making sure that you're allocating transactions correctly from a GST point of view. So it depends on your business as to whether you are registered for GST or not. Most of our businesses doing tax planning are registered for GST. So we can have a look at your bookkeeping and make sure there's no major errors there in relation to your books, so that we can rely on those figures for decision making. You can rely on your figures for decision making. You can run a profit and loss, you can run a balance sheet, and you can understand them and make decisions based on your business. So that's why tax planning is important. There's a few different reasons there. So it's all around making sure that your business is ready for tax time. and making sure that we're taking advantage of everything that we need to take advantage of. So I'm going to run through some specifics on what we do in relation to how to do tax planning, just in case it's up for something that you wanted to do as well. So the first thing that we do is we look at your books, and I'm going to run through a quick demo of the Xero demo company and show you some of the reports that we run and some of the things that we do in relation to checking your books for tax planning. So let me share my screen. So we can see here is our demo company of Xero. Now I love doing demo company in Xero because it is a program that resets for me every single month. So when I log in and I make changes in here when I'm doing the training, what happens is at the end of every month, it resets itself. It brings all those numbers back. I can show you the same reports every single time and I know what I'm talking about. The other reason why Demo Company is really awesome is because when you click on the drop down where your business is, you also have access to Demo Company. So you can, if you're not sure what to do in your own file and you're a bit scared of doing it, you can use the Demo Company as your cheat version, as your test. Go in there, break it, and you know what, it'll reset again next month, and it will be absolutely fine. So I'm going to do all the information and the session showing you on Xero, but the same reports and the same information is what we use in MyOb and other bookkeeping programs as well. It's just that majority of our clients now use Xero, so I do most of my training showing Xero examples. Okay, so what I love about Xero is that it has a fixed assets module. So when you hit on accounting and then go down to fixed assets, it has the ability there to record your assets that are there for depreciation purposes. So one of the first things that we do is make sure that any depreciation items or any equipment items that you purchased during the year have been entered, and we run the depreciation as well. So this unfortunately is not a function in MyOb or many other programs. This is special just for Xero. So we've got this fixed asset module and it lets you register your assets, check the purchase price and the purchase date, and then run the depreciation. So I don't have time to run through that for you, but if you're interested in knowing how fixed assets works within Xero, I can do a special training session just on that one. The next thing we do when we're looking at your file is checking whether you have any loans on your balance sheet and what the interest that you're paying on the loans may have, what impact it may have on your profit and loss statement. So this demo company has a little bit of data in there on the 30th of June, but we're actually doing end of last month. So end of last month, making sure that everything in the bank account is reconciled up until the end of last month, otherwise there's no point looking at it. And then from here, we're making sure that whether we've got any loans, and in demo company, we don't have any loans, but if you had a bank loan or if you had some hire purchase in here or some mortgages, then the interest on those loans should be put in to this system so that we can allocate the interest back to your profit and loss statement so that we don't tell you to spend more money than what you actually have when it comes to profit. So interest isn't something that you pay separate unless you have an interest only loan. Interest is something you pay within a loan payment. So we want to make sure that we're calculating the right amount of interest to go back onto your profit and loss so that we can work out the right amount of profit. And of course, we work out your profit because you pay tax on your profit. So this demo company does not have a loan, so we don't have any interest to bring in. And we also, while we're in the balance sheet, just making sure that these figures seem right. So as of the 28th of February. So a balance sheet is always as of a particular date. As of the 28th of February, how much is in your savings account? Is that correct and reasonable? How much is in your accounts receivable? So these are the people who owe you money, and is that reasonable? And you can run a receivables report to check that balance. Office equipment, so we'd go back through the fixed assets register and run that depreciation to make sure that was correct. Accounts payable, check that that's right. So the business bank account here is showing as a liability, so a minus account. So it would be a bank overdraft of 9670 sitting as a liability. So is that correct? If any of these items are not correct, then we need to rectify that before we start looking at the profit and loss statement. So everything we do on the balance sheet generally has an effect within in the profit and loss statement. GST, making sure GST is right, and then making sure your pay-as-you-go withholdings is right as well. So this historical adjustment account is a big no-no. So if you have an historical adjustment account on your balance sheet, you need to resolve that or get our help to fix it for you. This means that your opening balances weren't put in correctly, and when that happens, there's something missing in some other spot in your balance sheet, and potentially profit rolling forward or profit for the year. When we look at the equity on our balance sheet, it has two earnings figures. So our current year earnings, you'll see when we look at our profit and loss statement, matches the profit or the loss for the year. So this is a minus, so it is a loss showing on our profit and loss statement. Then we've got our retained earnings, which is our previous year's profits all rolled over together. So depending on how old your business is and whether you've made lots of profits over the years or lots of losses over the years, your retained earnings figure could be anything from a really big minus figure to a really big positive figure. Positive is better, and the bigger your positive figure, the better your business is running overall. Just as a side note, this minus total equity figure means, as a general guide, if you sold up your business today, you cashed out everything, you got collected in all of the money that was owing to you, and then you paid out all of the bills, you wouldn't have any money left over. So a minus equity figure is not a good place for your business to be in. So you always want to aim towards it being a positive figure, not a minus figure. Once we've reviewed your balance sheet and the balances on your balance sheet are correct, then we can start looking at the profit and loss and whether the business is making a profit for the year or not. So the default that's coming up is for the month of March, and that might be okay, might not be, depending on whether March has been finished or not. But it's going to run through just the March figures. So when it comes to tax planning, we want to look at the whole financial year, but remembering that we're only part of the way through the year. So these figures are not whole year figures, they're actually July through to March, looking at today's figures. So what we want to do is look at the figures, but then also extrapolate them out to see what the end of year figures might look like. So when it comes to doing tax planning preparation for the meeting, what we do is we ask, is there going to be any difference to the sales for the business? So we can work out what $53,000 is for the year, divided by 9, times by 12, so 9 because these are the figures up to the end of March, times by 12 because we want to see what the total would be for the whole year. So I'm just going to stop the share for a second and share my screen differently. So when I look at my little calculator app, when I go 53,878 divided by 9 times by 12, 53,878 over 9 months extrapolates out to about 71,837 for the whole year. So when we're looking at tax planning, we go, well, so you've done 53,000 to now. Is it likely that you're going to do 71,000 for the whole of the year? So if your business is in a seasonal type business and you do a really good winter season, so April, May and June is bumper for you, then our extrapolation of the divided by 9 times by 12 is not going to be right. So you need to give us that input. Similarly, if your business is in a slump between April and June, then that needs to be taken into consideration as well. So what we also like to do is not just have a look at this one column version of your profit and loss. We like to look at the multi-period profit and loss. So we're just going to look at the 12 periods and go update. And what that does is it shows us the trends that we need to know for the business. And look, it's giving us 12 financial years, which is not helpful for anybody. So let's give this one to June 2021. So 1st of June 2021 to the 30th of June 2021, so a month, and we're going to compare that with 12 months. The reporting function in Xero is so good, but sometimes you forget what you're looking for. So making sure your date ranges are right and your comparison periods are right makes it easier to read these reports. Okay, so because it's demo company, there's only a few months worth of data in here, and you can see that there's nothing there for the early months. Nothing there for June, July, August, September, October, November. There's nothing here for the later months. And there won't be anything here for the later months unless your data entry is wrong. So what we've got is we've got December, 12,000, January, 10,000, February, 20,000, March, 9,500. So what we do here as accountants is we export this to Xero and then we analyze the balls out of it. So what we do is we go, okay, well, your average for the total of those 4 months is 12,000 plus 10,000 plus 20,000 plus 9.5, and then divide it by the 4. So we get a nice average and go, okay, well, based on what you're currently doing, this is what we expect for the rest of the year. And then we can work out what those figures are going to be. So it ended up being about $71,000 based on the previous sheet, the previous calculation. So if that's right for your business, if that's what you think is going to be achievable, then all good. If it's not right, then we can adjust that and you can go, well, April's school holidays and Easter and we don't have as big a turnover then. So I'm expecting it to be $5,000 instead of the average. So we can make adjustments in our tax planning meeting to work out exactly what your estimates are going to be. The other thing we look at in this multi-period profit and loss is the expenses. So is there anything that looks like it needs to be extrapolated out? So the cleaning there, 155 every month for 3 months, that's probably going to keep being paid. Bank fees, $10.50 and then a $300. Well, is that $300 a once every quarter, once every year figure? And the $10.50 is consistent, or is it going to be consistently $300? So the planning side of things is understanding where your money is coming in on the income side of things, but also where your money is going out on the outgoings or the expenses side of the area of the business as well. And really having a good understanding of whether that money is coming and going can really help to get the tax planning right and give you a better estimate of what your tax is going to be. So rolling through, we just look at every single line item here. Is there any anomalies? So this rent of $2,500 instead of $1,500. What else was included in there? What else do we need to take into account when we're forecasting what your profit might be? And same with the wages, a smaller amount, 2 larger amounts. Maybe we're missing a payroll here and it should be $13,400 all the way through. So you can see this business not doing great. It's demo company, it's not a real business. So we've got 2 months with profits and 2 months with losses. So we're looking at quite big losses in respect of this business, mostly due to not having much income and having huge wages. So our wages bill for each month, so for the big months, is 13,400, and our income for January was 10,000 and our wages was 13,000. So the strategy around this business might be, how do you get more income? How do you get more clients? Can you put prices up? Or is there a staff member you need to get rid of, reduce, cut their hours back, or pay them less? So there's options here for this type of business to go, well, these are the strategies that you need to put in place so that you're a sustainable business, so that you can then pay tax because you're making a profit. Now, there's absolutely nothing wrong with paying tax because you're making a profit. We just don't want you to pay more tax than what you have to. And what does that mean? It means we make sure that you're putting everything in that you can. So if there's anything missing within your expenses, then we like to ask that question, what are you missing? So is there something that the business owner has actually paid that hasn't been bought in yet? Now, how would we know that? Only by asking you that question. So it's really down to making sure that we claim absolutely everything we can. And sometimes that's asking you if you've spent something that's not recorded yet. So we rely on you to read these reports and tell us what's missing, as well as us reading these reports. When we've had a look and we know that our profit and loss report is correct, as sad as this one might seem, it's correct. It's demo company, so there's nothing much to fix. We can then go into Excel and do our analysis. So with Xero, when you throw reports out into Excel, sometimes the formulas don't work if you don't press the enable button. So we're enabling the editing so all the formulas work. So now we can do some analysis and put some formulas in and check to see if that's right. So this June figure belongs to the previous year. So we'd never look at June 2020 when we're doing July through to June tax planning. So I would change that to a total and then put some sum calculations in there to add it all together. So from here, we know that our total income that we've got in here is 53,000. So if we know that April is going to be 10,000, May is going to be 12,000, and June's going to be 5,000, then we can run those numbers. This is our total estimate for the year. And then from there, we can run through and go, okay, well, this is what all our totals are. Let me just sum total them across. And then from there, it's a matter of checking where those totals are at. So that formula looks correct. Income minus expenses is profit. So that's what it is. So this business would look at a profit of $19,000 if we had income added in there, but no expenses. So obviously we'd go through and we'd adjust all of the expenses as well, so that the recommendation is correct. But we're going to work with a profit figure for today's example, because working with profits is much more fun than working with losses. Because when it comes to losses, my strategy is you need to stop spending money and start making a profit in your business. So a loss will generally roll across to the following year. So if you've made a loss of $8,000, then you need to make back $8,000 next year before you even get to a profit situation. So what my advice is when you're making a loss is to stop making a loss. Increase your income, increase your prices, decrease your costs so that you can make a profitable business. And if your profit is nothing for the year, then there's no tax to pay. If your profit is minus $20,000 for the year, you have no tax to pay. So what have you got to lose by making $20,000 and getting your business back to a zero? Okay, so once we've worked out our estimated profit for the year, then we can work out what the estimated tax is. Now, it can be, as not always, it can be as simple as working out what 26% of the profit is. And that's for a nice, easy business. So nice, easy business, 26%. A company, like I said earlier, if it's a company, you'll pay tax at 26%. If it's not a company, so you're an individual, then there'll be different tax rates depending on how much you earn. So what we want to do here is then work out if there's any, what accountants call as add backs to the profit. So one of the huge things that a lot of business owners are caught back on is if you do not pay your superannuation, you cannot claim your superannuation. So if within your profit you had a claim, now demo company doesn't have superannuation, so I'm just going to change this word to say superannuation. And I'm going to put another $500 in there. Okay, so if superannuation of $620, so there's the total there, $620 worth of superannuation, if you've applied that to your payroll, and clearly it's not enough because it's not 9.5% of the wages there. So we're just playing fictional numbers here. So if your profit and loss shows that you've accounted for $620 worth of superannuation, but you physically have not paid it yet, then you can't claim it as a tax deduction. So when it comes to working out how much tax you need to pay, we can't claim 26% or pay tax of 26% on your profit here because your profit wasn't 18,865 if you didn't pay the superannuation. So what we need to do is we need to do some adjustments. So unpaid super needs to be an adjustment. So if you haven't paid your superannuation in your business, then you don't get to claim it as a tax deduction. So your taxable income is going to be that plus that. Cool. Numbers to be. So instead of paying tax on 18,865, you're going to have to pay tax on 19,485. So 5,066 as a penalty for not paying that superannuation. And then we look at other things that you may or may not be able to claim as well. So some of the things some businesses claim are not tax deductible because they're more private. So things like entertainment. If your entertainment is purely entertainment, so taking people out to bars for alcohol or movies, theatre, box seats at the football, most of these are classed as entertainment and they belong off in the fringe benefits tax world rather than as a tax deduction world. So it's really important to make sure that you're not putting things through your business and trying to claim them when they're private. So entertainment generally is private and not business related. So if you're buying cartons of beer, don't want to see it in your books because it's not claimable. So we'll look at things like entertainment and go, well, really that's not a tax deduction either. So oops, I need to move myself so I can shift. So entertainment. So now our taxable income is more again, and the tax is creeping up because we've put things in the books that are not tax deductible in relation to the business. So our advice is to have this tax planning meeting, see what is tax deductible, what isn't tax deductible, so that you can then be aware of what things need to be changed in order to get that tax deduction. So our advice is scrape some cash together if you're fumbling around with cash, and actually pay some of that superannuation off this year so that you can get it as a tax deduction. It's showing as an expense, but unless you've actually physically paid it, then sorry, it's not a tax deduction. Same with your entertainment. Yes, you might have spent X amount of dollars thanking your staff for a great time, but it's not tax deductible for your business in certain circumstances. So we'd have to take it back out of your claims. So this is an important part of the tax planning, is understanding what can and can't be claimed and making adjustments so that you can make a difference when it comes time to doing your tax. So if it came to you finding that $620 when we physically pay it, then it's going to reduce that tax bill by 26%. So you spend $620, reduce the tax bill by 26%. We also have a chat about your business in our tax planning meetings in relation to some of these things, as well as other things such as, is your income for the whole year okay? Is it sustainable? What sort of things do you need to cut back on costs? And due to our experience, we can sometimes tell you other businesses are getting better deals on certain things. Sometimes we can, sometimes we can't tell you those things. And we look at then what a break-even point is for your business. So when it comes to how much income you have and how many costs you incur every year, what's that right level? What's that budget amount that you need to make? And then and then that gives you something to aim for with regards to a budget figure. Some of the other strategies that we talk about in a tax planning meeting, and I'm going to stop my share. Some of the strategies that we talk about in a tax planning meeting include superannuation. It includes whether entertainment or there's other things that might be private in your profit and loss that are not tax deductible and they need to be adjusted or accounted for. We talk about asset purchases and how that's going to impact on your profit, not just this year, but for future years as well. We look at whether you need to increase or decrease wages to employees, or more importantly to the business owner, to take advantage of increased or lower tax rates depending on your business type and what other income you're earning. We look at key performance indicators. So looking at whether your business has a lot of debtors, so people who owe you money, or creditors where you owe a lot of money out, and how that's impacting on the cash in your business as well as impacting on the tax in your business. So for every single invoice that you send out to a customer, that's included in your income and it's included in your profit for the year, and you pay tax on that. If somebody still owes you money for that invoice and you haven't collected it yet, and it comes time to doing your tax return, if you haven't collected it yet, you still have to pay the tax on that income. So collecting your money is an important part of running a business, as well as checking your bills list as well. So you might be putting bills into the system and showing that you've got accounts payable. And then when they're coming into your bank feeds in your file, you might be putting them in as a spend money, which is doubling up on that cost in your profit and loss. And so checking these things, checking your accounts receivable, checking your accounts payable, making sure that they're real numbers impacts on your profit and loss statement, because it shows as income in your accounts receivable. It shows as a cost in your accounts payable. And if they're not correct, then your profit may not be correct. And if your profit isn't correct, then how do you know you're paying the right amount of tax? So making sure that those figures, those accounts receivable and accounts payables are correct, means that you've got the opportunity to make sure that your profit is correct and you're paying the right amount of tax. Now, when we're talking about accounts receivable and sending invoices out, if people haven't actually paid you and they're not going to pay you, for example, they've left town or their business has closed down, or you can't locate them, even doing a bit of Facebook stalking, you can't find them anymore, then it's wise to write those bad debts off. So a bad debt is an invoice that's more than 12 months old that you're not going to collect the money from. And from an accounting point of view, from a tax point of view, it means you don't have to pay tax on that invoice if you're not going to get paid on it. So it's important when we're looking through our accounts receivable report that to be honest and say, yes, I am going to collect that money, or no, I'm not going to collect that money. We also talk about stock as well. So if you're in a situation where you hold materials for your customers or hold stock on your shelves, then are you realistically going to sell it? And what are they realistically worth? So we value your stock in most cases at the cost or the lower of what's realizable. I know jargon, I hate accounting jargon. The net realizable value of stock is what you can actually sell it for. So if you bought a book, I always use books as my example for stock. You bought a book for $10, but realistically you can only sell it for $5, then you should show it on the books as $5 worth of stock, not $10 worth of stock. Alternatively, if you bought a book for $10 and you can sell it for $25, we show it at 10 because that's lower than what you can sell it for. So understanding how stock movements in your business is really important for tax planning as well. Then we talk about the timing. We talk about timing of invoices, of orders, of placing materials, of ordering materials, and also paying those bills as well. So from a profit point of view, when you order something and you get an invoice for it, you can claim it as a tax deduction. But from a GST point of view, if you're registered on a GST point of view for cash, then you want to pay for it so that you can get the GST credit back in the next BAS rather than in the following BAS after you pay for it after the end of the quarter. So there's timing issues there with regards to income and expenses that will impact on your profit and loss. So if you send out all your invoices on the 30th of June, then they count as income and you pay tax on that. If you send out all of your invoices on the 1st of July, then they don't count as income for this financial year, they count as income for next financial year. So the timing of when you send invoices out is important as well as when you purchase things. We also think about things like the structure of your business. So if you're a sole trader, we look at the benefits and the costs or cons of changing to a company. If you're in a company structure, we look at whether that's the right one for you or not. If you're in a trust, we have a look at what sort of pros and cons are there for staying in the trust. Running a business through a trust isn't my favorite thing, but there's opportunities for looking at whether the structure of your business is correct or not. We also, for companies, look at dividends, whether it's appropriate to send dividends out to owners. If you've got the cash available to do so, then that's an awesome thing. And we look at anything else in relation to the business that may need a bit of sprucing up. So looking at the depreciation schedule, looking at the balance sheet, making sure there's nothing there that the business owner or the bookkeeper thinks that should be in the business that isn't showing there. I love going through a depreciation schedule with a client and going, okay, so this schedule shows that you own 10 cars. Do you have them all? And there's some businesses who go, yes, absolutely. They're all parked out in the yard and used on a daily basis. And from some of my clients, it's, no, we got rid of that one 3 years ago, and this one was gone 2 years ago, and this one, and I've just bought a new one. So there's some updates to do. So we look at all of this stuff in tax planning, and it's taken me nearly an hour to explain to you all of the things that we do within tax planning. But the main one is making sure that your business is on track. It's making money. It's doing what it's set up to do. So living your lifestyle, making money for your family, whatever the reason is for your business. That's why we do the tax planning, and making sure that you don't pay too much tax, but making sure that you do make money and paying tax is okay. And if you do have to pay tax, knowing it in advance what that estimate's going to be so that you can make sure you've got the money set aside for it is invaluable. So having that second bank account set aside for tax so that you know you've got enough. When it comes time to sign off that tax return and get it lodged, you can get it paid the same day. I hope this has been super interesting for you and you've been able to follow along with all of my examples. And I really invite you, if you've gotten to the end and watched all of it, get in touch and tell me what the best thing you think about tax planning is, because I'd love to use that as a testimonial. Get in touch if you've got any questions. And thank you so much for watching.